We are not going to have a 2008 type of housing market collapse. Stick around for today's video and I'm going to explain in detail what is different this time and why we're not going to have that type of collapse.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor, on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Hello, my YouTube friends, and happy Saturday. I hope you're all doing well. Kind of excited to do today's video, excuse me, because I really like the housing market. I've always liked real estate, even when I was young, and I want to go into what I see as being different this time than last time. And I know that sounds kind of funny because why are things different this time? They're never different, right? I mean, the reality is people always say that, but there are some underlying fundamental things that are going on differently than what was going on in 2008 when the housing market started to correct. And I'm going to get into that and explain it in the detail. And the main difference is the type of loans that were being offered back then, and primarily one that was called the option arm. Those of you who are kind of old like me may remember it. And the worst part about it is they were doing them with what was called stated income, stated assets, meaning you didn't have to really provide any documentation. You just had to have your credit pulled and have a certain amount of minimum credit scores in order to qualify. And the scary thing is, the lower the credit, as long as you qualified, the higher the commission was to the people who were selling it, which created an opportunity for all sorts of fraud and problems and people just taking advantage, which is why they don't even offer the loan anymore, which me as a mortgage broker thinks that's a real shame because it's actually a good product. It just got abused. And instead of requiring mortgage officers to be responsible for the product that they sell, they've decided that I guess we're all too stupid to really understand it and that we just have to make the product totally illegal so we can't offer it anymore. Now, that's just me being on a little like podium complaining about the things that happen because, to be fair, most of the salesmen don't really understand what they are selling. And the more I listen to some of them, the more I understand why they make those rules. But I still feel like maybe people should have to understand what they're selling, explain it to their clients better so we don't have these major catastrophes. Again, soapbox. If I was, dividend investing with cheese, I would have some funny pun here about my PP or something about nipples getting hard or something that would make that all tie together and be pretty funny because I kind of like when he does that. So what I did is I kind of took some numbers, I ran with it to give you an idea of what would happen if you had one of these types of loans. Now, every month your statement would come and you would be given 4 different options that you could choose whatever you wanted and make that payment, hence the option. And one of them was an adjustable rate. So the ARM part of it is adjustable rate mortgage. But it wasn't quite an adjustable rate mortgage. It was just different ones mixed into your 4 different options. So I put up, for example, a $550,000 loan amount, and then what even worse on top of the stated docs and no income, no assets, and all the things like if you watch The Big Short, it does a good job of talking about some of this. But you could get a first loan for the mortgage and go, let's say 90% loan to value, meaning you're putting 10% down, but you could actually qualify for a second for the down payment for the additional 10%, which is so nuts. Now, that means you haven't given any documents to show your income. You haven't given any documents to be able to show your assets. You just state them. And then you've borrowed 100% of the money between 2 different loans. And the small one for the down payment was usually at an outrageously high interest rate of maybe 12% or potentially even higher to be able to come up with that down payment. Now, if I go back to that time, I was beginning to get in the industry. I'm arguing with the guy teaching the class saying, but what if real estate falls? My wife is kicking me under the table, telling me to shut up and let the guy teach the class. And he's just looking at me like I'm nuts, telling me that real estate never falls. And we go to one of the new home builders and look at homes because since I'm getting in the industry, I'm trying to make connections and hand out my cards. And and build a business and whatever else. We go in, and I'm going to make a, I don't even remember what home builder it was, so I won't even say it. And I had finished as a commodities trader and I had done really well, so I had a good amount of savings. But I had just moved out to Las Vegas and hadn't really started a job, so I didn't have any income at the time. And I'm filling out the paperwork as if we're going to buy the house. And it gets to the section of your income. And I write down that I make, I don't know, say $30,000 a year, but I'm making it up, I don't remember. And we're looking at the house and whatever, and the end of the day, we're like, okay, sure, we want to buy one. Now, we didn't really want to buy one, and we're just going through the process. But the loan officer goes, oh, you can't say that, crosses it out on the piece of paper, writes 200,000 for income, and says, we'll just say it's 200,000 so that way you qualify for the loan. And then I go home and I'm on my way home. And I'm thinking, and I said to my wife, that's so ridiculous. You fill out this paperwork, they ask you how much money you have, they ask you about your income, and that if the guy selling you the loan recognizes that you tell him you make less than you need to qualify, he just crosses it out, changes it to what he thinks you'll need to earn to be able to qualify, and I've still produced no documentation. Now, imagine all the people going out to buy homes who couldn't really afford it, just saying, sure, I make this kind of money, and sure, I have that much in assets. Because as long as they qualify, that guy gets a commission and he sells the house. Already a problem. Now let's go to what you get in the mail for your options in terms of payments. And maybe you're comfortable with some of these payments, and maybe they've gone over it and explained that when you get your statement, you get to choose whatever you want. Well, the option is you can make a 30-year mortgage payment, which is what most of us are familiar with. You could pay additional and make the equivalent of a 15-year mortgage payment. You could do an interest only payment, which is going to be less. And you could even do one that is what's called negatively amortized, which is less than the interest payment. And how does that work? Well, let me give you the examples of the ones that I drew up, excuse me. On a $550,000 loan, if you're making a payment on a 15-year mortgage, and I think, I don't remember exactly, so please, none of this is real estimates. This is just what I think I plugged in. I don't know if I did 4.5% or 5.5%. And quite honestly, I don't even know if they included taxes and insurance and things that would typically be included in an estimated payment. But you would get in the mail, let's say your 15-year optional payment is about $4,200. If you wanted to make a 30-year payment instead, your payment would be about $2,790. If you only wanted to make the interest only payment because of the way that mortgages work, that was about $2,050. And then you would have that additional option, and maybe that was a $1,400 payment. Well, the difference between the interest only payment and the negatively amortized one is $660. So each month you would have the $660 added on to your principal balance. So let's remember you've already put no money down. And again, I'm using a $550,000 home, $550,000 total in loans. Your second loan works very similarly. So very little of the principal is getting paid each month, as you have to make that payment as well. And the example I gave was only on the 500,000 for the home. You now add the $660 less the little bit that you've paid off of that second loan. So now you've gone to owing $550,000 and the 660. So you're now owing more than what you paid for the house already. Now let's fast forward a little bit to where the house prices began to drop. Because my guess is for most people, when they get those four different options in the mail and they look through the four different choices of what they're able to pay on their mortgage, they look down, they see the cheapest one, and they think, Well, why would I pay more? I'll just pay the cheapest one. Now, if the loan officer explained it really well, which maybe they did, maybe they didn't, most of these loans had 5-year maturity dates to where they would season and they would turn into a normal loan. Meaning, after the 5 years, you no longer have the option. It now morphs into the balance of a 30-year loan, and they do the math of how much you owe over the next 25 years to figure out what your new payment is going to be. So it's going to be more than the 30-year mortgage of 2,790 that I gave you an example, and you won't have those choices anymore. So for 5 years, you're making approximately a $1,400 payment every month, adding an additional $660 to your principal balance. So over a year, what's that? 6,600, 72, almost $8,000 a year you're adding on to how much you owe. So over 5 years, around $40,000 you've now added on to how much you owe on the mortgage. So you've gone from $550,000 loan to a $590,000 loan on a house that you spent $550,000 for. And at the end of those 5 years, you now have to start making bigger payments. A lot of people got these loans. So when the house prices started to drop, and at the end of their 5-year period, somebody in this example now owed $590,000. Their payment is closer to $3,000 a month instead of the $1,400 they were paying. And add into that, the house prices started to fall. So now you have a house, let's say, worth $400,000 that you owe $590,000 on your mortgage, and all of a sudden you're paying $3,000 a month instead of $1,400. And then you start to look at rents and realize, geez, I could rent this place for $2,000. I owe $190,000 more than it's worth. And a lot of people started thinking, why am I keeping this home? Which then in turn pushed the prices even lower because you had so many people into these types of loans. Fast forward to today, where the opposite is true. You have people with interest rates of, let's say, 3.5% on 30-year fixed mortgages, where the values of the homes have gone up. So while you might have people who are having trouble making those payments and have concerns about foreclosing, as opposed to going to the bank and saying, forget it, you take the keys. I owe $190,000 more than the house is worth, and my payment's going up so I can rent it for less or I can buy another one for less. You have people who have extremely low payments with equity in the home, so there's just no reason for them to actually foreclose because they're not upside down. They're more likely to, you ready for this? Sell. If you bought your house in the same example for $550,000 4 or 5 years ago, and today it's worth $750,000, unless you've refinanced and somehow gotten into a position where you owe more than what the house is worth, why would you foreclose? Why wouldn't you just sell it for the 750,000? You don't owe more. You didn't have a negatively amortized loan like the other option I was talking about. So you owe less. You probably put a little money down. Why wouldn't you just sell the home, make the money of the house being worth more money, and then figure it out from there, even if you couldn't afford to buy another home? And I really think you'll beg, borrow, and steal, or have your kids move in, or your parents, or whoever, to be able to try to keep that loan in that home at the low payment. I mean, I ran the math of if we had to put 20% down at today's price and today's interest rate versus when we bought the house, when the rates were really low and the prices were cheaper. And the price has gone up per monthly payment almost 3 times. It's like 2.5 times what our current payment is. So if we ran into a position where the payments became really tough, I would talk to my sister about sharing it with me or my brother or something to be able to do whatever we could to try to keep this home because the deal is so good, as opposed to what happened in 2008, where people had terrible deals because of the loans they put on and what was going on in the housing market. Even if the housing prices started to fall, there's so much equity built into it based on what's happened over the past 5 years. It would have to fall by more than half before it starts eating into where maybe we begin to be upside down, on top of the fact that we put a down payment. So it would have to be even more than that. It's completely different this time. Now, that does not mean we can't have price correction, especially the longer we sit around the same interest rates and prices and the markets normalize. But when you think of what's gone on and people look at the prices thinking, man, houses are just too expensive, they're going to collapse, you need a reason why a bunch of people are going to start selling at the same time. And when they have equity and when they have low payments, there's just nothing that's going to push them into panic mode where they all start selling at the same time, because there isn't a reason. And then add into it that they have all the equity in it now. They're just not going to panic sell and just drop the price, drop the price, drop the price. They might decide to just stay in the home and they might lower it a little bit, but I don't see the same type of pressure of my payment just doubled and my house is worth less than what I paid for it. Why am I keeping the home? Does that make sense as to why I don't see a correction or a big crash? I mean, obviously, corrections can happen anytime. If we have unemployment and it gets worse, there would be some people who can't make their payments, and maybe we'd see more houses come to the market. But again, way different than what went on in 2006, 7, 8, 9, 2010, where everybody who and their parent and their brother and their cousin bought homes lying about their income, lying about their assets to be able to buy these things because they just go up in value. And if you haven't watched it, watch The Big Short. It's a great movie. It's entertaining. It gets into this stuff a little bit in a simplistic way that kind of explains what went on, it's a good way to learn about it. Again, completely different situation today versus what happened back in 2008. So I just don't see a big crash like that. I think good opportunity. Buy a house if you can afford it. Don't buy a house if you'd rather rent, especially if you move from time to time and you think you're going to, not be in the same area in the next couple of years or things change. Again, as always, like I say in all videos, this is not financial advice. Please don't listen to me. You need to do your own research and fit what fits you and your financial decisions. I am just a guy on YouTube who's talking about what's worked for me. So please reach out to a financial advisor, do your own research, make your own finance decisions, and don't follow me or anybody on YouTube for that matter. If you could, though, hit that like button, hit that subscribe button, and make some comments. Tell me if that made sense to you guys and you understand why I don't see a big housing correction and what's different this time versus last time. I do think there's a potential that Trump's trying to run the stock market down to try to get the Fed to have some pressure to cut rates. So we might see the interest rates drop a bit. And I think that actually helps support the housing market where it could actually continue to go higher. I hate to say that for those who haven't bought and don't own already, but I think it could get less affordable because there are a lot of people out there like me that are kind of stuck in these low interest loans and wouldn't move and can't move because they see that as an actual value and an asset. There's no way we could afford the monthly payments or get into a home for the price that we already did. So we're stuck here. And I think a lot of people are like that too. Again, thumbs up, like, subscribe. Have a great day. Have a good weekend. I'm going to try to post this video as well as the one about TSLY. Talk to you soon.